Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good weekend, all. Ira Epstein with your weekend edition of your financial market wrap-up for this Friday, February 1st. Yeah, it's 1st of February already, 2019. And this will be where your settlement prices are. We just are reopening at the 3:30 time frame, so the markets will oscillate, but this is about where the market's going to finish out the week. It's been a crazy week. You know, the weather in Chicago, in fact, the whole Midwest was absolutely horrendous. A lot of traders haven't gotten back. Today was probably the first day that we're operating normal, and by Sunday, it'll be just gorgeous in the Midwest. I mean, 50 degrees in Chicago from a negative 50 below zero. You heard me with the wind chills. Without it, still record-setting in the low 20s, negatives. All right, what about the market? Well, the event for the week was the Fed, and the Fed taking a very dovish stance on what they're going to do going forward. People looking at foreign economy, seeing weakness. Of course, we're waiting to see if the trade deal with China goes through. President Trump is saying, again, how friendly he is, one of his best presidential friends, the president of China, and they're going to have to sit down and work things out. But behind the scenes, things are going on. The whole game's going to be intellectual property, forced turnover of coding. You don't want any of that to go on. Trade, nah, you'll get the trade one way or the other. In fact, the beans were up even today off of ideas that's going to be good, but look at how much it sold off from the high. We know that China's buying beans right now again, but we need regular buying, and not by the state-operated firms, but by the commercial operators. That's very important to what's going on there. When we take a look at where you're at on a monthly area chart of closes, for those traders that think this is still no more than a bounce in a bear market, they'll hang their hat that the market's sort of stuck at the monthly 18-day average of closes. On the 18-week moving average of closes, the market finished off over that by about 30 points. So momentum's there. The question is, has the market spent any of itself from here? I can tell you, if you go out and you do your research on stock indices, and you do it according to a report that I read, I think it's called the Kitchko report. And they went in and they talked about what happens when you get a blowout number on employment like we did today, adding 304,000 jobs, that the market, the first week after that is typically a bit higher and even a month higher. So things you want to look at, and might want to look that up. I think I saw it in CNBC, but I read so many news articles during the day I don't remember. The bears are going to hang on to this too. See the Fibonacci study from the high to the low? While the daily charts show one picture, you're into what I call that box, this area where the market should have the resistance between the 50 and 62% retracement. Now keep closing over that. I'll throw that out, obviously, like I did in the metal markets. But right now, that's might be what they're hanging their hat on. The market's got a pattern of higher lows, higher highs, which is bullish. Take out 2612, which is about 90 points away. That creates a problem for the market. It breaks that pattern. The market had fallen. First of all, it had rallied up to the 100-week average 3 weeks ago, pulled back to it for support last week, and this week surged forward again. All positive things on the chart. Support back at the 2672 level. You're nowhere near lower Bollinger Bands or upper one, so I'm not going to say they're in play or in any manner. Right now they're there, but they're far away. Momentum-wise, momentum is pointing up. So you have an uptrend at work. You have higher lows, higher highs. Bias is up because you're over the 18-day average. Support comes in two areas. The 100-day average, 2625, and 2672.50, the 18-week average. And they're weekly averages instead of, if I said daily. In the NASDAQ, just like the S&P, I'm showing you the highs and lows of what this market did with the Fibonacci's. So you're in that box again. You're in that area of 50 to 62% retracement where resistance is often seen. It's tying together again with the 18-week average. It's over it. I can tell you just looking at this market that you'd have the swing line up and looking good. Dow. Now this closed over the 62% retracement level. If next week is an up week, I throw out the Fibonacci. The market has to pull back now, back into these boxes. That's my theory on that. You don't want 2 weeks out of it. The Russell doing just what the other two had done. It's now approaching the 50 to 62% retracement. So in plain English, we're at an area that probably develops resistance. That's my point. When I look at the VIX, the trend remains lower highs, lower lows. Fight is happening at the 18-week average. Momentum still down, bias down. Support the 100-week average. I keep saying day, week, at 14.18 with resistance at the 20.55, the 18-week average of closes. In T-notes, you've come up to a big resistance area. We had gotten here before when we got over the Bollinger Band and up to the 100-week average. Now you've gone back to that 100-week average and you're fighting there. The one thing that's clear is you've been in an uptrend with higher lows, higher highs. To break out of that, you've got to get under 121.02. Momentum sort of drifting here, not pointing to the upside. In TLT, not a trend. So in this popular ETF, you have a higher high but a lower low. Momentum has gone flat on you, and you're having a lot of resistance showing up at the 100-week average of closes. You had one spurt, in fact, two spurts up to the upper Bollinger Band, couldn't hold that. In the dollar index, the long-term charts are looking bearish. You've got lower highs, lower lows, supports under the market from 94.69, the lower Bollinger Band to 94.37, with resistance, the 18-week average of closes at 96.07. In the eurocurrency, I wish I could say it's a mirror image of the dollar. It's not. It's got a lower low and a higher high. The battleground's the 18-week moving average of closes. There's rather formidable resistance from the 100-week average at 116.70 to 116.25, right in that area. I wouldn't be surprised to see the market still fight a battle at that 18-week average of closes. In the British pound, some analysts would say that this combination, including me, would say that very, very hard to get through the 100-week and the upper Bollinger Band. Market acts, forget it's the pound, just as a chart. Market acts like it might need to pull back towards that 18-week average to regroup. If it doesn't, it's still going to have, whether it goes another rally there, it's going to have formidable resistance right there. In the Canadian dollar, the trend is up. Momentum is measured by the swing line up. Higher lows, higher highs, support back at the 75.61 level with resistance showing up rather well, a good amount of it, between 77.26 to 77.55. In the Japanese yen, we've had a nice bounce in a market that's got a pattern of higher lows, higher highs. We had that one blowout week, if you remember it, about, a month ago, where the market went crazy in price to 94.58 when we all thought the economy was in trouble. And then the market has fallen back as traders have, pulled back from this. But the trend is up and stays up unless you take out 91.29. In Bitcoin, the longer-term charts remain very bearish. Momentum is locked into the downside. You have lower highs, lower lows. So you look at this chart, still, what I'll say, in the ugly side, hasn't shown anything that it's ready to turn back up. In the differential between Brent and WTI crude, it is narrowed in from the November timeframe of 10.66 a barrel difference, where Brent was higher than WTI by that, got as low as 6.87, and it's on its way back down. So what's happening is apparently WTI is acting stronger than Brent as the market's been moving. Now, if we look at the Brent, we can see that we have a downtrend with lower highs and certainly lower lows. That pattern gets broken if you get over 63.12. If that happens, the first resistance point would be obviously the 100-week average at 63.77 and up to 65.66, the 18-week average. You have divergence on this chart. You've got momentum pointing up, bias down, and the trend down. In WTI crude, the market, because of the outside week up, now has what I'll call higher lows and higher highs. So the swing line's up. You have a lot of resistance from 56.70, the 18-week average, up to the 100-week at 58.08. Momentum is up, bias is down because you're under the 18-week average. At least that's how I define it. Gasoline's got divergence. Momentum has turned up, bias down, trend down is measured by the swing line. You'd have to take out 146.77 to negate the lower high and lower low pattern. It would put into place higher lows, higher highs, and possibly set up a challenge of the 18-week average. It would be a little lower than this 156. It's falling right now at the rate of about 3 cents a week, so that would drop down into the 153 zone likely. In the nat gas, you know, if you read newspapers and you're reading about the freezing, and by the way, I'm one of these guys that used to be like that 50 years ago, and you're going, oh, this is going to drive prices up. Look at how it's freezing. Gas prices got to go crazy. Well, they collapsed during this whole freeze that we've had. So you don't go by that. I remember watching national TV news, and I used to tell people, by the time they announce it on the TV news, fade it the next morning. We didn't have electronic trading during that time. It was the best signals that I knew. Again, public's the last to know things. Lower highs, lower lows, still very much in a downtrend, momentum down, bias down. You put it all together, you've got markets that are interesting as can be, and I cover them each and every morning in my subscriber video. Now, I appreciate you watch these, but this is not the meat and potatoes of what I do. Not close to it. In my morning video, I'm able to say, buy here, sell there, here's a day trade, here's a strategy trade, something longer term, shorter term, what I see. My charts look just like this. I am not in the video. I record over there. I have another recording studio for that. You have a cup of coffee, and then I'm going to walk you through the markets. And I do it in a certain way. I follow this exact pattern from the stock indices all the way down to the energies so that you can jump around the video and not have to watch what you don't want to see. Then you're going to get a definition of the chart action. I show a lot more than you see in any of these videos. Then I'm going to tell you what I think the pros are doing in the marketplace. Technical and fundamental analysis, and I will throw out trade ideas left and right to you. During the whole storm, I didn't miss a beat. I was able to put these out, miss nothing during the freeze that we had in Chicago, because while I couldn't make it in the office for these videos, I could do that from any computer I have anywhere in the world. That's the beauty of it. How do you get it? I charge for it. The first 30 days, $7.95. You don't like it, you don't have to continue. After that, it's $15 for every 30 days. It's not a month. It's 30 days approximately at a time. And I am going to come out with a yearly subscription. You can call my staff. You can go to our website. Under the words education or research, you'll see morning subscriber video. Click on it, and away you go. I'm Ira Epstein. Thanks for watching.